Well, hi, everybody. This is Linda with the Connecticut Real Estate Investors Association, and Happy New Year to everybody. And on the phone, I've got Ted Lanzaro. He's one of our preferred vendors. He's a CPA, and he's a guy that, quite frankly, I rely on a lot of for accounting advice, and I refer coaching students to him all the time. He's actually a real estate investor himself. Ted, you just told me today that you just sold a rehab property. Is that correct?
Yeah.
You finally got it under contract?
Yeah, we got it under contract, and hopefully it's going to close by the end of the month.
Nice, nice. And then you've also done some wholesale deals last year. So is that what you were telling me?
In the meantime, while I was holding this property, I did a few wholesale flips of some multifamilies in Bridgeport.
Oh, cool. Very cool.
Yeah.
So we should talk about that someday. But tonight we're going to be talking about totally legal strategies for increasing your cash flow. And I did ask Ted if this information is going to be good for a while, and so he's going to talk about that. But it should be good for a while. I just want to make sure that you do grab paper and pen, or a laptop, or an iPad, or something to write your notes on. There is a place under chat for questions, either one that you can type in a question. And oh, by the way, could you all just, if you can hear me now, could you please type in right there under questions or chat that you can hear me? I'd appreciate it. But that's the place where we can add questions. And Ted, are you okay if at the end of this presentation we can take a few questions? Is that okay with you?
Oh, absolutely, yes.
All right, great. So cool. So and Ted, before we get into the nitty-gritty stuff, I know you've been a member of CTRIA for quite a few years, and why why are you part of the organization? What's it done for you lately? I guess is the question.
Well, yeah, it's done a whole lot for me. I mean, I don't think I'd be in the real estate business if it wasn't for CTRIA. A lot of the information that I learned at the meetings is things that I use in my business, along with the contacts, which I think is probably the biggest thing. The people that I've met. So I met my hard money lender. I met my contractors. I've met people that I've wholesaled deals to. I've met people who I've bought deals from. Without any of those people, I mean, that's basically my entire real estate business.
Wow, that's awesome. Well, Ted, I'm going to let you take this away because you're the master of all this info. So why don't you go ahead and let's just see what you've got for us tonight.
Okay, well, that sounds great, Linda. I mean, tonight we're going to talk about 7 totally legal strategies that landlords can use to not only increase cash flow, but also to minimize taxes. So that's like the really important part of that is you're going to increase your cash flow and lower your taxes, so you get to keep more of the money that you actually make.
Absolutely.
I'll tell you a little bit about myself. I've been a tax consultant for the real estate industry for 22 years. Like we were just talking about, I am an experienced real estate investor. I've done rehabs. I've wholesaled. I've been a landlord. And in my accounting practice, I've represented hundreds of investors, from a guy who owns a 2-family house down the road to a billionaire mall developer down in Florida that I used to do tax work for. So I've got a lot of experience with all kinds of real estate stuff. There's always new stuff coming along every day, but there isn't much I haven't seen that people have been doing. So we're going to talk about 7 strategies. The strategy number 1, which is keeping good records, it's the foundational strategy for all tax savings and cash flow optimization. Because without good records, you can't implement the good tax strategies. So you need to have good records. When we talk about real estate business, there's a lot of people who they're very casual about it. I don't take that kind of approach. I always treat my real estate business like an actual business. So I'm going to have a separate LLC for it. I'm going to have its own bank account. I'm not going to run things through my personal accounts. I'm going to have a filing system where I keep track of all my documents. I'm going to keep everything, my bank statements, my closing statements, my insurance policies, just like I would for my accounting business or whatever business you're in. I'm sure, with CTRIA, you have to keep your bills and your checks and your bank statements and all that.
Correct. Correct. And I agree with that also. I think what we found is that the people who have been members of CTRIA year in and year out, are the ones who treat it like a business as opposed to a get-rich-quick scheme or a hobby, either one. So.
Yeah, and my most successful clients that have come from CTRIA, my most successful investor clients, are those people who actually treat it like a business. You know, and that's what they get up and do every day, and they're successful at it. You know. One of the things that I emphasize is having some type of an accounting system to keep track of all of the things that you need to keep track of, as far as, you know, what the money you're paying out, the money you're taking in, maybe you're putting things on credit cards. You have to have some system for tracking all of this information, and it doesn't have to be anything complicated. I have clients that that do it on a spreadsheet. I have clients that do it on a piece of paper, literally on a pad of paper. It all depends on you know, how complex and how many properties you're trying to run. The more, obviously, the more stuff you have, the more complex it's going to get, and maybe you do need a QuickBooks or something along those lines to take care of something like that. You know.
Right.
There's some definite no-nos, things that I want people to stay away from doing when it comes to keeping good records and implementing the strategies. The first one is having separate bank accounts and not commingling your business and personal funds. This is like one of the biggest mistakes that I see people make. It makes it incredibly hard to track all of your expenses and deductions. And when things are coming out of multiple accounts, and you know you're constantly paying things. You know, I have some clients who pay stuff from their personal account, and then they pay some stuff from their business account. Some stuff they put on one credit card. And they may have 5 different credit cards that they're trying to, you know, put things on or whatever. And what ends up happening is they lose track of all the money they've spent, and they're not getting all of their deductions because they're not able to put it all together for me. You know. And so having, you know, a business account where everything runs through, it just makes it so much easier to make sure you're not missing any of your deductions, okay? And some of the other things, you know, you have to keep people, you know, like I have clients who, you know, you'll ask them for a closing statement or ask them for their bank statements. Oh, was I supposed to keep that? Well, yeah, you are supposed to keep that. You know, you need to have good records. Those closing statements are how we figure out how to depreciate the value of a property. You know, we need to know what you paid for it, you know, and we don't want to just go, oh, I think I paid like, you know, $100,000 for it. Well, you know, we have to actually track that and track how much money you put into it, especially now where a lot of people are buying properties, a lot of landlords are buying properties and then having to put money into them to make them rentable. So that's a big deal. You really want to be able to track all of those costs so that you end up getting every dollar that you're entitled to as far as deductions.
I think that's a really good, important point, because I didn't know for years, actually, that I was supposed to save that. And the settlement statement thing. Oh, settlement statement. I just thought that was a bunch of paperwork I had just signed without reading. So, yeah, all those numbers on that settlement statement actually mean something. And
right,
it does make a difference in your taxes either that year or in the future. So, yes, very, very good point there.
Yeah, absolutely. Especially when you go to sell the property, you want to know that you've tracked all of the costs that you put into it, because that's how you calculate a capital gain, you know, when you go to sell the property. The other big no-no I would say is there's a lot of people who only see their accountant like on you know, April 14th, you know, and that's really not the right way to do it. You want to make sure that your accountant knows when you sell a property or when you buy a property, because there's things that we know how to do at that time that are the things that are the foundation for saving you tax dollars. So when somebody calls me and tells me, or somebody comes in on, you know, March 15th for me to do their 2012 taxes, they say, oh, by the way, I sold a couple properties during the year. Is there anything we can do to minimize the taxes? Well, at that point, there are a couple things we can do, but really, most of the good ones were things that had to be done in 2012 if you were going to take advantage of them, you know. And so, you know, it had to be done during the year. You can't go to the next year and try to do these things. So it's always imperative that, especially when you sell a property, that you contact your accountant and say, hey, you know, what is this going to cost me in taxes? Because if you don't know how much the sale is going to cost, what your gain is going to be, and what it's going to cost, how do you know if you're making a good deal or not?
Mm-hmm.
You know, that's the reality of it. So that's a big no-no. You definitely should be speaking to your clients or speaking to your accountant before you buy or sell a property.
Absolutely. Very, very important. Absolutely. And
Right.
one of the things that I was talking to when I met with my accountant, because I just sold one of our properties, and I had a meeting with her, and and one thing she said is, please don't sell it, the last 2 months of the year. If you're going to do anything, wait till January. So, but I had to make her aware of what we were doing and look and see what the capital gains was going to be, and that precipitated what I needed to do, whether I needed to do a 1031 exchange or not. So.
Right, exactly, and especially now, because what we're talking about, these strategies are stuff that are going to become more and more important, because tax rates have actually gone up beginning in 2013 for people who are for making over $200,000 single or $250,000 joint. And what happens is, you may not make that much money at your job, say, for example, or in your business, but when you go to sell a property and you have a $150,000 or $200,000 gain, on a property, then all of a sudden that money adds up with your wages and your interest income and all your other income, and all of a sudden now you're over those numbers, and you're looking at a much higher, you're looking at a capital gains rate that's almost 9 points higher than if it was under 250,000. So all of these things become really, really important now that rates have gone up for large capital gains and that sort of thing.
Right, right. Okay, good.
So the second strategy I want to talk about is actually being able to take the maximum amount of deduction on your rental activity. And the way you do that, if you can, is to become a real estate professional. Before I get into that, I just want to talk about what typically happens if you're not. So if you're an investor in a property, but you're not doing any work, you're not collecting the rent, you're not dealing with the tenants, you're not calling for repairs, you're not doing anything. Literally, you have a management company that takes care of everything, or you have a partner that takes care of everything, that sort of thing. That's considered a passive activity, and in that case, your passive losses are only the losses on those rental properties you're only able to offset those against income from other rental properties. And if you don't have income from other rental properties, you can't offset those passive losses against your ordinary income, like your wages, for example, or your business income. Mm-hmm. So that's one. But so the second category is what they call active participation. And in active participation, you must have a substantial involvement in managing the property, and you must own at least 10% of the property. And if you do that, if you're active in collecting the rents and making repairs and those sort of things, even if you're just calling for repairs, well, then you can deduct up to $25,000 of any real estate losses against your wages and business income, and that's a big benefit for a lot of people. Now, unfortunately, that loss limitation does get phased out for people whose income falls between $100,000 and $150,000, meaning that you get to take, as your income rises, you get to take less and less of that $25,000 loss, and once you hit $150,000 in income, then you actually lose that loss until the next year when you're able to possibly take it, depending on what your income is. So
there's a certain number of hours that you have to be to qualify for that active participation, correct? 500
hours, yeah.
Right. So keep good records. So I can tell you this from personal experience. My accountant had used this deduction for us, and a couple of years later we were audited, and so we had to show on our calendar, on our calendar that we had shown up this day, this day, this day. Use this mileage to show up to all the property, so keep good records as far as that goes. Once we did, they went away. I mean, we passed the audit, it wasn't a problem, but we had to prove it.
Absolutely, and that's where having things, when we talk about keeping, what we talked about before, keeping good records, you want to have a log of the time that you're spending, and we're going to go over that in a minute, but that's a great point, because you want to have some sort of a log where you're saying, this is how many hours I spent on the property today. This is how many hours I spent on the property. This property and that property. The other thing that you have to keep in mind is there's actually an election that needs to be made, because, especially when we go to the next slide, which talks more about becoming a real estate professional, The eligibility for being a real estate professional means that you have to spend more than 750 hours on the property, and it's got to be more than 50%, or at least 50% of what you're doing. So think of it from this standpoint. You can't work at your other business, say, for example, more than another 750 hours. Unless you're in the real estate business. So if you're a real estate agent, a real estate broker, a developer, then that all counts. But you have to aggregate it all together. And what happens is the IRS comes back and says, well, wait a second, you may have spent 750 hours, but you spent, let's say you had 5 properties and you spent 150 hours of each property. Well, you need to make an election to aggregate all of that in order to get to the 750 hours. Otherwise, they say you need to have 750 hours on each property, unless you make this election. So, wow. I mean, how many, if you had to spend 750 hours at each property, how many properties could you possibly own? I mean, right? So that election, which is something that a lot of accountants miss, is something that absolutely has to be done, so that all of your real estate activities are included as one activity. Okay?
So what you're saying is, because I never heard this before, so what you're saying is that if you, like being a passive investor, you'd have to do 500 hours per property? Is that what you're saying? No,
you would file the same election. You would want to aggregate that 500 hours.
Oh, okay.
You would want to say, I'm making an election that everything I do real estate-wise, even if it's on 10 different properties, is actually one entity or one activity. Okay, gotcha. As long as you make that election, then you're allowed to aggregate. If you don't make that election, then yeah, it's either 500 hours on one property or 750 on another. Depending on which status you're trying to achieve.
So, and what is the difference? Do we have time in this conversation? What's the difference?
We do, because if you're a real estate professional, you get unlimited losses, not subject to any limitations. So you can make all the wages and business income you want and still be able to deduct all of your real estate losses if you are, in fact, qualified as a real estate professional.
So where this could come into play, I think, in realistic, and when we first acquired all of our properties, we were doing a lot of renovations all the time, and so we had tons and tons and tons of expenses, right? And so that was the issue, because we were limited, and I think we had to spread things out over a couple of years, something like that. So what you're saying is that if you're in that situation, if you're considered a real estate professional, you wouldn't have to, you could just take it all in 1 year. Is that what you're saying?
That's exactly right. You could take it all in 1 year, and you would not be subject, and it would offset whatever wages or business income that you had. So if you're sorry. Okay, go ahead. I'm sorry.
Well, so if you're listening on the call and you're a rehabber, you definitely want to become a real estate professional. Or if you're acquiring a whole lot of rental properties and you're going to be spending, and that you're going to be spending that those kinds of rehabs, then it's going to make sense for you to select that option and to talk to your accountant about it at least.
Yeah, absolutely, and it's mostly it's not necessarily for the rehabbers unless they're rehabbing and then holding the properties. This is really for landlords. You want it because you want to be able to take the rental losses.
Okay.
On the properties.
Okay.
Yeah.
Gotcha.
Yeah.
Okay,
and
good.
Rental losses, you don't have to be losing money on the property to have rental losses, because what happens is you positive cash flow and you're actually making money. The depreciation on the property will actually create a loss. That's why real estate is such a great tax shelter, because you can actually make money and not pay any taxes because of the depreciation of the cost of the property. And we'll talk a little bit about that, and that's what's so great about what you're doing with the coaching group, is you're teaching these folks how to go out and buy these rental properties and create a great passive stream of income that they're not necessarily paying taxes on.
Exactly. You can actually make a profit and show a loss.
Right.
Weird.
That's exactly right. Yep.
So good. All right. So continue on.
Okay. So we're going to go to the third strategy, and the third strategy is kind of comes off of strategy 1 about keeping good records, and the third strategy is taking every possible legal deduction you can. Okay. And I always say this expression, pigs get fat and hogs get slaughtered. The thought process is that you want to take every legal deduction, but you don't want to get into that area where you're way past the legal deductions, because that's when you're going to get audited and you're going to have a problem. So everybody knows that you can deduct, or most people know that when you have rental properties, you can deduct things like mortgage interest and real estate taxes. You're going to be able to depreciate the property. You're going to be able to deduct your insurance, your utilities, the advertising, your business miles. But typically, most people who do rental properties are going to come to me with this basic information. But some of the other things that they don't know that you can deduct, things like the maintenance or commissions you're paying to lease the property, or my fees or your lawyer's fees, for doing the accounting, for doing the taxes, for doing the closings, that sort of thing. Property management fees are deductible, repairs, office and household supplies, all the, even the paperwork stuff that you have to have in your house to be able to run your real estate business, your paper clips and your calculator and computer and all that stuff are actually deductible. So, and then here's where people really, start to miss out on things, which is they don't take their administration expenses. So they have a cell phone, they're using it in their business. This thing is a little dated because you can see I put in pagers and beepers. I don't know when the last time somebody carried a beeper around with them, but but cell phones, your telephone in your office supplies, all of this computer supplies training. Like I train a lot of people on how to use QuickBooks for their real estate business. That training is deductible. The internet that they have at their house, the business-related seminars that they go to, all of these things are deductible. And if you're running your real estate business out of your home, then you can deduct a portion of your home expenses against your rental properties and against your business income in the real estate business. So it's really one of those things you have to keep good records in order to be able to take every possible legal deduction. And I always tell people, some accountants will be like, oh no, you don't want to take every deduction, that you're going to get, you're going to have too big of an expense and you're going to end up getting audited. Well, that's not necessarily true. I mean, you're entitled to take every possible legal deduction, and you should be doing that and minimizing your taxes. So I always go with, as long as it's legitimate, we can back it up, then we should take it.
Sounds good to me.
Okay. Some other administrative kind of expenses. A lot of people, do like magazine and newspaper subscriptions for the real estate business, marketing and promotional items, your business cards, your postage, your bank charges, you can take some meals and entertainment and those kind of things. And you want to take all of those things and make sure you're tracking them and make sure that you're taking all these legal deductions, especially if you're able to deduct them.
What's the deal with going out to eat with people, taking them out for breakfast and that kind of thing?
Well, like when I meet with other investors all the time, and so I would say, okay, you know what, I had breakfast with Linda, and we discussed the property at 123 Main Street, and I'm going to deduct, 50% of the meals and entertainment. That's the law. I mean, when you do that kind of stuff, you're only able to take 50% of the deduction, but you still want to track the deduction. And as long as you put who you met with, what the business purpose of that was, and the cost, then keep that receipt, then you're good to go on that.
Mm-hmm. Yeah, exactly. Okay. Good, perfect.
So the next strategy is has to do with repairing and improving your rental properties. So there's a big difference between a repair and an improvement. And the big difference is that a repair, you're allowed to immediately expense against your rental income. And an improvement is a fix-up that actually adds value or extends the useful life of the property, and that has to be depreciated over 27 and a half years for a residential property and 39 years over a commercial property. So it's a big difference. There's a difference between a $20,000 immediate deduction and being able to deduct like $727 every year for 27.5 years. I mean, it's a huge difference, and it requires, and even the IRS says it requires some judgment how to do it. But here's some basic guidelines that we're going to talk about, and so here's 8 strategies that you can use to immediately expense a repair. And so when you're repairing your properties, and you may be doing some improvements also, you want your contractor on his invoices to segregate the repairs from the improvements. What I mean by that is, let's say you have a contractor who is, let's say, putting a new roof on the property, which would be an improvement, but he's also going to be fixing some flooring in the apartment. He's not replacing the whole floor, but he's going to fix a portion of the floor. Well, you want him to put that on the bill as 2 separate items, so that you can be able to classify it in your accounting. One is a repair, one is an improvement. The other strategy is when you fix something, you don't have to always want to fix like a small portion of it. So you don't necessarily, let's say you have some a broken wall. You know, somebody punched a hole in one of your walls in your apartment. Well, you could either patch the hole, or you can like literally take the whole sheetrock down and replace it. You don't necessarily need to pull down all the sheetrock to patch a wall. You know, so like those kind of things, you don't have to replace an entire floor to fix one broken board. You know, those kind of things. So you always want to fix the smallest amount that you can. You always want to use comparably priced materials. You don't want to replace mica with granite, or maybe a wood floor with some very expensive wood floor. So you don't want to expense, you don't want to replace oak with, Brazilian cherry or something that's going to, cost you a lot more money. So you always want to use, comparably priced materials to what you were already using. Fixing damaged areas only. Don't go crazy trying to make everything perfect, because if you do that, then it becomes an improvement. The other thing that people can do, and this is really something that's very very interesting, is repairing after an event. So let's say you, for example, you had a flood, a pipe broke in your house, and it made a little flood. Well, that's a great time to go in and fix everything up, because all those things after an event can be classified as a repair.
Oh, okay.
So that's always, so if you do have something weird like that happening, that's a great time to go in and fix things up, because you're going to get better better repair classification when you do that. A lot of people don't.
There's some kind of use for Hurricane Sandy. Is that what you're trying to tell me?
Well, it could be something like that. Yeah, I mean, if you had, if something got damaged during Hurricane Sandy, let's say just as an example, you had some broken. Well, I actually had this happen in one of the houses that I wholesaled in Bridgeport. It was in a neighborhood where all the streets got flooded, and there was water in all the basements. And what happened was the water in the basement was high enough that it actually got into the furnaces. And so the furnaces, and it was salt water because it was right near the ocean. So the water that was coming in was salt water, not like rainwater. So if you get salt water into like a mechanical, into your furnace and stuff, it's done. You might as well just throw the thing away.
Exactly.
So in that case, the person I sold it to knew that they had to replace all the furnaces. But then what they also did was they replaced the hot water heaters. They fixed up some other stuff in the house that wasn't even in the basement. Now all of those things will be considered repairs because they were all things that needed to be done as a result of the storm. So if you use an event like Hurricane Sandy as sort of an excuse to do all the minor repairs and fix up that need to be done in the house, then you can deduct it all as repairs, not as improvements.
Okay, good. Beautiful.
The other thing that people have a tendency to do is they don't, they tend to try to improve do the repairs in between tenants. Well, you really should try for the best you can to do things during occupancy. the more repairs you do while the tenant is occupying the property, the better the chances you're going to be able to classify it as a repair.
Oh, didn't know that. Okay.
And also, when you go to put it on your books as a repair. Actually classify it in your accounting as a repair, and because that's something that when if the IRS were to audit you, they're going to look at the classification. Well, did he classify it as a repair or if he classified it as an improvement? And if you classified it as an improvement on your books and then you deduct it as a repair on your tax return, that's going to be something that trigger them to reclass it as an improvement, and you're going to lose that deduction. So, so that's sort of kind of where we're at with that. The fifth strategy is cost segregation, and cost segregation is just a fancy term for accelerating depreciation. It's taking the component parts of a building, whether it be a two-family house or a big apartment building or a commercial office building, whatever, and breaking down and trying to figure out how much of the cost of the property can be allocated to items that we can depreciate faster than over the 39 or 27 and a half years. So it's 27 and a half residential, 39 commercial, but every building has some 5-year, some 7-year, and some 15-year property in it. So 5-year property, for example, like in an apartment building, the 5-year property would be the appliances in the kitchen, the sinks, the cabinetry, the tub, the sinks, the vanities, all of those things that are in properties, and not only that, and the electrical and plumbing that service those things. Okay, so you can take and allocate the cost of a property, and you can allocate and take pieces and say, okay, this kitchen stuff is 5-year property. Now we can instead of deducting it over 27 and a half years, we can deduct it over 5 years. So you get a faster timing, and so you get a larger deduction. So $20,000 over 27 years is $727. $20,000 over 5 years is $4,000 a year. So we go in with an engineer, and we do these studies, and we determine, and typically you can take about 20% of the cost of the property and convert it to either 5, 7, or 15-year property. And like parking lots are 15-year property, driveways. So that's another good. So we always take a portion of the driveway or parking for any apartment building we have, and we allocate that portion of it to 15-year property. So we take, let's say you paid $1 million for an apartment building, we're going to take $40,000 or $50,000 and say that relates to the parking lot, 15 years. And so, we're going to get a better depreciation deduction.
So who determines that when you say we do this? So
we go in, an accountant and an engineer, a building engineer and an accountant. We go in and we identify all of the 5, 7, and 15-year property in a building via an inspection. And then the accountant goes and then with the engineer we cost the stuff out. So we determine what portion of the total cost of the property related to those items. Okay, using experience and knowledge of building materials and that sort of thing. And then I go in and I create a depreciation schedule based on those allocations, and then that allows us to create a report that is the documentable evidence that the IRS accepts in order to do this.
So what size building would this make sense to do?
Anything over maybe $500,000 or $600,000 of cost.
Okay.
Okay.
So if y'all out there,
that's when you do that. That would be if you're going to do a formal study.
Okay.
Typically, if I'm doing something for a two-family house, somebody buys a two-family house in Waterbury, and it costs them $100,000. Well, we're still going to do the same item. We're just not going to do a formal report,
Okay.
because we're not going to be able to take as much, but we're still going to break out all the kitchen and bathroom stuff, and we're just going to be a little more conservative about it. So if you're so for a formal report for buildings over $500,000 or $600,000, a less formal thing for smaller properties, but we still do them.
Okay.
Yeah, and it's a great way to accelerate depreciation and make a bigger deduction in the first 5 or 6 years that you own a property. And again, typically those first five or 6 years, those are the years where you're going to have the highest, interest expense and that sort of thing. So the more depreciation you have, the more taxes you're going to save, the more cash flow you're going to have. So this is a big cash flow builder because it's going to allow you to keep more cash in the first 5 or 6 years of the property.
Okay, good.
Strategy number 6 is something that I think is going to become more popular now with the higher capital gains rates that we're going to be seeing in 2013 and beyond, which is the 1031 exchange. And a 1031 exchange is basically when you sell one property and turn around and buy another one within a certain period of time. And it's probably the most powerful wealth building tool in the real estate business. And I'll give you an example. I know a guy was a client of mine down in Florida, and he started out, he was like a plumber, and he went and he was buying all kinds of small apartment buildings, small residential apartment buildings. Over a course of about 5 or 6 years, he accumulated like about 60 or 70 units, and he also had like a small warehouse and a couple of other different properties that he owned. And at one point, he turned around and he sold the whole portfolio to another investor. Okay. And when he did that, he had a big gain, and we were at that time we were in a highly appreciating market. And so what he did was he turned around and he bought a shopping center, rundown shopping center. And so he did a 1031 exchange. He essentially exchanged his 70 plus units for one shopping center. And then what he did was he renovated the shopping center and he filled it up with tenants. And by the time he went and turned around to sell it, it was worth another $2 million more than he had paid for it. Okay? And so he sold that shopping center to somebody. And then he went and he bought 6 auto zones in Texas, and using the money that he made from the shopping center. Now, the auto zones in Texas were basically triple net leases, which means the tenant basically takes care of the entire property. So there was very little management aside from collecting a check every month. So now he lives on, literally, he was able to retire at like maybe 45 years old, and he basically just collects his rent checks every month from these, auto zones in Texas, and he's never paid $1 in capital gains on his real estate because he's always used 1031 exchanges to sort of climb the ladder into bigger and better properties. And nice. And right now he's he went from basically working as a plumber and owning a bunch of rentals to basically doing nothing and collecting somewhere in the neighborhood of about 40 grand a month.
Nice.
Yeah. So
you think this is going to become more popular because the capital gains are much higher now, or will continue to increase? So
right,
this is going to delay the capital gains. Okay.
Exactly. There's more incentive to actually do these exchanges. Now, you still got to be able to find the properties, and the properties have to be like kind, so you have to be trading investment property for investment property. Short-term flips don't qualify because there's no intent to hold, so you can't do this with rehabs. Okay. But you can trade apartment buildings for commercial properties and and that sort of thing, as long as they're both income producing. So it's a very, very powerful strategy.
By the way, one of our vendors, Matt Kaliwa, is a 1031 exchange qualified intermediary, which you must have to have that done, and he's very, very knowledgeable about the rules, the ins and the outs of this. So
absolutely, and I know him. So yeah, he's very knowledgeable. That's exactly true.
He got trained by the guy that wrote the book on 1031 exchange. So he got trained by Dennis Karen, who literally wrote the book on 1031 exchanges. And so he's taken over since Dennis has retired. But you and I had talked about that this is a great, great strategy when you're talking to somebody that wants to sell and you want to be able to buy it on owner financing, right? That you could do 1031 exchange, but you can it's a lot easier to do owner financing or convince them of that because of the capital gains issues.
Yeah, because and we're going to talk about owner financing in a minute, but with the exchange, you have to identify. You have 45 days to identify a replacement property and 180 days to close on it. Okay, so you're under time constraints, and if you can't do that, that's always the biggest constraint in doing it is you got to find another property. you
right.
know, so and so that's always the big bugaboo, and you definitely do not want to try to do this without professional help. You need to have an accountant who's well versed in it. You need a guy like Matt to guide you along the way to make sure you stay within the rules, because you can blow these up pretty easily, And so if you don't know what you're doing. But with that being said, I've had people call me 2 days before closing and say, "How do I do a 1031 exchange?" And we ended up getting it done. So you just have to do it before you sell the property.
Great.
So hopefully,
okay, good.
within more than 2 days.
Hey, right.
So
cool.
So strategy 7 is the installment sale, what we were talking about. Okay, and so we can look at that from 2 standpoints. We can look at it from both the seller and the buyer standpoint. As a buyer, if you're in the market as a buyer and you're looking for people who will do owner financing for you, that's like the ideal situation, because now you don't have to go to a bank. This is the stuff that you teach in your coaching program, which is so valuable. It's how do I buy properties for little to no money down without having and not have to go to the bank for financing? Well, this is the way to do it. And so if you understand it from the seller's standpoint, you can explain to your seller how he can sell the property and not pay any taxes. And the way that he can do that is to hold the mortgage. So that's exactly what an installment sale is. It's when your seller holds a mortgage for you and only collects monthly payments instead of getting all your lump sum money like they would if you went to the bank. And then so by doing that, they only have to pay the capital gains on the money they actually receive every year. So let's say we have a property, and one seller says, "Well, I just want the money. Give me all the money." Well, he's going to pay the tax on all that money in that year, and that can be the difference between. And in that year, let's say he has a $500,000 capital gain. Okay. Well, now his capital gain rate is like 25%. The same guy, if he were to do an installment mortgage, instead of getting the $500,000, maybe he's going to get $15,000 a year for 20 years, or for 30 years. Okay, so he's going to get 20 grand for 30 years. Well, that $20,000 doesn't put him into that higher tax bracket where he has to pay. So now he's paying lower capital gains. He's not getting all his money, but in a lot of cases, what all these people are going to do with the money is put it in the bank and collect 1% anyway, on the interest.
Right.
So if you can give them, make them a deal, give them a decent interest rate, and it beats putting that money into the bank at in a CD or something. You're giving them a better rate of return, and you're saving them a whole bunch of tax dollars, especially in this environment where big capital gains are going to generate higher taxes than lower capital gains.
Excellent.
So people who understand that can really be in a position to convince their sellers to be able to do that. So typically the way that works is the gain is reported as each payment is received. So you get your 12 payments every year. You only pay tax on the 12 payments that you receive, not the whole balance of the sale. So it's a great strategy.
Excellent. And does the seller get the mortgage interest deduction, or does the buyer? So I guess
no, the buyer would get the buyer is paying the interest. The seller actually picks up interest income. The seller picks up interest income. The buyer deducts interest expense.
Right. Okay. Good. Okay. Sorry, I made that complicated. Go for it.
No.
Okay, we're almost.
Yeah, we're almost there. And so I've got a couple of bonus strategies for everybody that's on the call. I'm a big believer in tax planning. I would say always meet with your accountant prior to year end and before purchasing or selling a piece of real estate. I think that's the most valuable way you can use your accountant, and the way that you're going to take maximum benefit of the tax laws is to be meeting with them. And with my clients, you know, I do frequent check-ins with my clients, call them often. I encourage them to call me when they have things going on, and let me know what you're doing. I want to know what people are doing. Just even from a practical standpoint, I may know somebody that can help you, you know, or there's been times when you know, somebody was like, oh, how do I do this, or how do I do that? I get a lot of calls from your coaching people. Would you call the other guy's accountant and explain to him how an installment sale works? I'm happy to do that. I want to help investors make deals, because there's too many people out there who will help them blow up a deal. I'm actually trying to help them make a deal, you know.
Thank you very much.
Yeah, you know. So always take a look at your property tax bills. Make sure they're in the ballpark. If you have a big increase, you know, ask why. You know, it never hurts. You may get some sort of a reduction or something by questioning it. And if you operate from a home office, make sure you track your business miles on your car, because you know, your mileage starts the minute you walk through the driveway and out the door. So always make sure you're tracking your auto mileage on all your rental properties, especially if you have a home office.
Nice.
So to conclude, let me just tell you, you know, so the last slide is, you know, why Ted Lanzaro? Why would you want to use me as your account? Well, before we start taking questions, let me just tell you a little bit about why you would want to do that. I've got 22 years experience as a real estate CPA. There isn't much in the real estate business that I haven't seen. I've represented all kinds of different kinds of residential and commercial developers, landlords. I represent a lot of real estate brokers. I've probably, over the course of my career, represented about 50 or 60 We Buy Houses companies. So I don't know that there's a lot of people around that have more experience, you know, representing real estate people than I do. I've also been an active real estate investor for 11 years. I've done wholesaling. I've rehabbed, you know, 15 or so houses. I've landlorded 6 or 7 or 8 houses over my 11-year career, and I hold an active real estate license. I take, you know, real estate CPE and all of that. So I'm very active in the real estate business, even though my primary business is as a CPA. And I also share all of my relationships, my contacts, my attorneys, contractors, everything I have, I make available to my clients. And I think a lot of my clients who have used this find that without that, I end up making them or helping them make a lot more money than they ever pay me for their tax work. And that's, I think, probably the biggest thing, is that I'm more than willing to share all of my various relationships. And in fact, they'll often put, you know, clients together for deals. You know, so I do that pretty frequently. So if you're interested in talking to me, my phone number is on the screen, 203-922-1742, and my email, ted@lanzarocpa.com. You can also check out my website at www.lanzarocpa.com. And Linda, if you've got any questions, I'd be more than happy to take them now.
Sure. And of course, if you forget all this for some reason, you can go to CTRIA to the Investors Corner, and then under the Service Directory, you'll see Ted's info. So here's a question. I think it's from Winstead. Is the Series LLC available in Connecticut like other states? If not, when will it be? You know what that means?
Well, that's a good question. I don't think it is available right now, and I have no idea when it would be. What I always tell people about the Series LLCs is I like the concept, and I just don't know that I'd want to be the test case for the state of Connecticut. You know, in other words, if you were challenged, I wouldn't want to be, you know, if you were challenged on it, because there are some, you know, some intricacies and some things that the state could come back and say, well, hey, you know, are you paying, you know, all the taxes that you should be paying as far as business entity tax and all that? I just don't know that I would want to be the test case there. I think I would wait until you know, it became legal here. With that being said, you can go and form. There's no reason why you can't form LLCs and own property in the state of Connecticut.
Okay.
There's just filings that you have to do.
Okay. All right, good. Then I'm not sure what this refers to, but let me see. Jennifer is asking, does that apply to LLCs? Me and my husband actively manage a rental property that is owned in an LLC that we are members of.
Yes, it does. That's
okay.
exactly. Yeah, that's exactly correct. Doesn't matter whether you own the property personally or if you own it in an LLC, if you're actively managing and participating in it, all the same things apply.
Oh, okay, good. Yep. So, and then Nicole asks, if you take a deduction for a home office, does it make it complicated when you sell your home?
It doesn't make it complicated. You do end up recapturing the depreciation that you took on the home office. So let's say if you deducted $500 a year, because don't forget, the amount of depreciation you're going to take on a home office is pretty minimal, okay, because you're only deducting, 5 or 10% of your house cost.
Right.
So let's say you deduct $500 a year for 5 years. When you go to sell your home, you have to recapture that $2,500 of depreciation and pay taxes on it. But you got the benefit of it for 5 years. So
right.
a dollar now is worth more. A dollar deduction now is worth more than what you would pay out 5 years from now. Just because of the time value of money, money's more valuable now than it will be 5 years from now.
And my understanding is that you no longer need to have an entire room set aside as your office. That if you have like one section of a room, as long as it's completely dedicated, you can figure that out.
Right, and you want to somehow partition it off a little bit.
Okay.
Either
Great.
with
So
like a Chinese screen or some sort of curtain around it or something. Yeah, it should be partitioned off.
Excellent. And Aaliyah says, does this work for mobile homes? So I guess all the
if you're renting mobile homes, yes.
Okay. Yeah. So a mobile home rental is treated the same way because mobile homes are treated as I thought they were treated as like cars and motor vehicles.
If you're living in, my understanding is, and if you're renting a mobile home, and like if it's in a mobile home park, and it's, it's not like a mobile home like an RV where you're driving it around all the time, but
right.
if you're like a mobile home, like in a mobile home park, that's a rental property.
Yep. Okay. All right. Cool. Unfortunately, someone had a lot of trouble with the sound, but it seems like they can hear us. Okay, can you explain, Jim wants to know, can you explain the 1038 procedure with a little more detail? Can 38 swap, I think it means 1031, swaps work with quick turnover property flips?
No, they can't, because you can't do them with flips, because there's part of the law is that you had to have the intent to hold, or you had to hold or have the intent to hold. So you want to make sure it works best when you have rental properties. It's not a hey, I just rehabbed the property and now I'm going to sell it and I'm going to turn around and do a Section 1031 exchange. You can't do that. It's not part of the tax code.
Okay. Somebody's asking, if I do an assignment of the title with a homeowner, but I paid their mortgage and all expenses associated with the property, but the mortgage is still, hey Pat, I haven't seen you in like forever. I was just thinking about you. I hope you're coming to the Fairfield RIA coming up in a couple weeks. I just thought I'd do that shout out there. If I do an assignment of title with a homeowner, but I pay their mortgage and all expenses associated with the property, but the mortgage is still in their name, do I get to depreciate the property on my taxes?
If you mean by assignment that you are now the owner of the property,
yes, that's
in other words, they've done a subject to. Is that the idea?
Yes, exactly.
Okay, then you own the property, then you get the depreciation deduction.
So I guess that was my question too, because at the end of the year, you have to make arrangements to make sure, like the mortgage bill at the end of the year, you're going to have an interest expense,
Right.
So you're making the mortgage payment.
It's in their name and it's being reported under their Social Security number. But the reality is you wrote the checks, and as long as you have as long as you can show that you made the payments, you're entitled to the deduction.
Okay, good. And George, so all that stuff, by the way, should be negotiated in the paperwork that you do with an attorney. That's why you definitely want to do closings with an attorney and not try to do them on your own. So even if it's a lease option or something like that, you definitely, with any of these creative things, you definitely want to use an attorney. George is asking, how often do you give Quicken lessons and where do you give it? That's a great
Yeah,
question.
I do QuickBooks lessons by appointment, basically. I don't do group kind of things. But when people come in, I have a guy in my office who is a QuickBooks certified advisor, and he would be happy to sit down with you and show you how all the basics of how it works.
Great. Awesome. And that's it. So you did a great job. So Ted, thank you so much. That was great information. I am recording this, so y'all, I'm sure there's so much information you want to come back and re-listen to this. So it will be posted up probably on this event page, and we'll send out that information. And Ted, just thanks again for doing this. Thanks everybody for being on the call. I really appreciate your questions. Look forward to seeing you. We have a lot of events coming up over the next month or so, in the next 6 weeks. We wanted to get 2013 off to a fast start, so I hope that all of you join us for all of those things. So, Ted, anything else? Any final words you'd like to say?
Just, anybody has any questions, and they can just pick up the phone and call my office or send me an email. I'm happy to respond. And thank you very much for your attention.
Yeah, Ted's, you can tell by his demeanor, he is just really great with people. So don't be afraid to ask him any questions. He's there to answer them for you. So, all right, everybody, have a great night, and I'll see you all soon. All right, take care now. Bye-bye.
Thank you. Bye.
Bye.